Hello everyone, thanks for checking out my video. What an incredible comeback by the US stock market as it erased the losses from 5th August rough sell-off and closed out the best week of 2024. Following the comeback last week, the S&P 500 is currently only 2% away from its all-time high that was set in July. The amazing reversal was likely due to a series of positive economic data, which has helped investors in shaking off the recent fears that the US was veering towards a recession. Without further ado, let's dive straight into some of those economic data and discuss what could bring the stock market to yet another all-time high. As usual, keep watching on to find out more. Well, it was quite a turnaround for the US stock market. All three major indexes closed higher last Friday to clinch their biggest weekly gains of the year, with investors regaining their confidence after the massive sell-off on 5th August, a mini Black Monday. The incredible recovery was aided by data that suggested the US economy was holding up better than what was initially feared. Basically, investors got a plenty of reassurance on the economy for the last 1 week with two softer than expected inflation data, a surprisingly strong retail sales report, as well as a decline in jobless claims. To put things in simple terms, this series of data show that inflation is on track to fall towards the Fed's 2% goal. At the same time, the prolonged high interest rate environment isn't causing anything to crack in the economy yet, as consumer spending holds up pretty well and unemployment rate isn't getting out of control. Following the positive data, investors' confidence in the US economy was restored, leading to an upbeat sentiment in the stock market. As a result, the market rebounded, recovering trillions of dollars and erasing all of the losses incurred during the early August sell-off. Moving on, let's cover what to watch this week. Well, the upcoming week is a relatively quiet one in terms of economic data, but there are other key events to keep an eye on. First up, on Wednesday, 21st August, minutes from July's FOMC meeting will be released. Based on Jerome Powell's last post-FOMC meeting press conference, the minutes could indicate some inclination for at least a 25 basis points rate cut in September, which is in line with market expectation. As of the time of recording, data from the CME group shows that the odds of a 25 basis points cut is around 72.5%, with the remaining 27.5% expecting a 50 basis points cut. To summarize, the market expects the Fed to cut rate in September. The question now becomes what's the scale and how many times will the Fed cut this year? The next significant event that could influence market sentiment regarding the interest rate cut is scheduled for Friday, 23rd August, when Powell will speak at the annual Jackson Hole Symposium. Honestly, I don't anticipate any surprises or new developments from Powell's speech. He will likely acknowledge that a rate cut is in the pipeline and once again emphasize that the Fed remains data dependent, especially with the August employment report coming up. Just to share, at one point the market was anticipating an emergency 50 basis point cut when there was so much talks about a potential recession. However, given the recent positive economic data, I don't think Powell will discuss or signal a 50 basis point cut. I mean, this level of rate cut wasn't mentioned in the last meeting, and therefore I doubt it's in Powell's interest to commit or to discuss a 50 basis point cut at the symposium. He probably wouldn't want to front-run his FOMC colleagues. Moreover, Powell's speeches at Jackson Hole have typically focused on larger picture side of things, rather than getting into specific details. Let's now move over to the technical analysis section. I think it's quite obvious that SPY, or the broader market per se, is looking bullish based on two clear movements. First of all, as you can see, SPY has created a series of higher lows. That's bullish. Secondly, SPY has retraced to retest this green dotted uptrend channel and rebounded off it. Remember what I have always shared, the 3 R's: retrace, retest and rebound. When this happens, it's definitely bullish. Interestingly, the last time when these 3 R's happened in April this year, SPY went on to create a new record high. Right now, it seems like it's following the same path. But is it guaranteed? Well, nothing is guaranteed or certain in this world except for death. Anyway, I would think next week's Nvidia earnings could determine if the broader market can continue its rally beyond the record high that was set in July this year at 565. Just to add, another thing that I like about SPY's chart is that it has gone above the important 61.8 Fibonacci level at 554 with two nice green candles. Okay, before the bulls get all too excited, let's cover the downside as well. What I don't like about the chart is that SPY gapped up above the 61.8 Fibonacci level. I mean, if it slowly grind up above that level, I would say it's more bullish. But with that gap up, it means that there is then some possibility that SPY could retrace to fill that gap, which is between 544 to 548. Alright, I must say this gap area is really important. Other than being a support zone itself, it is also where the 61.8 Fibonacci level and the 50 moving average are. If the bears can bring SPY back below the gap, or in other words below 544, then it's slightly bearish in the very short term. After which, keep an eye on 537 and 531. If the overall bullish momentum is still intact, it should theoretically bounce from either of these Fibonacci support levels. Below 531, it means SPY is going back into the uptrend channel again. When that happens, then obviously that would have been a certain level of sell-off in the market once more. Some may feel fearful during such period, but I will be excited to enter to pick up some discounted shares again. Let's now jump over to Apple's chart. In my previous video, I shared that if Apple reclaims that 61.8 Fibonacci level at 218, that's bullish, and it stands a chance to move towards 222 to 225 area. Well, Apple did that and did it in style with consecutive green candles, and it is currently sitting at 226. Anyway, as Apple started to rebound, I had to plot out the new Fibonacci retracement levels. And guess what? Even with the new Fibonacci levels, it shows the same bullish trend as Apple has gone above the other 61.8 Fibonacci level at 221. Come this week, watch this level closely. To me, as long as 221 holds, Apple stands a very high chance to fill that tiny little gap at 231 to 232. From there, watch if sellers start stepping in to take profits or not. If Apple doesn't get rejected at 232, then naturally it has a pretty decent probability to test the all-time high at 237. Although I think it's quite an uphill task to recreate a new all-time high this or next week, I wouldn't want to short Apple at this moment with that few bullish signals, which are a breakout above the blue downtrend line, 10 straight green candles, and MACD curling up. In short, Apple's trend is very bullish now until proven otherwise. So how do we know that Apple's bullish trend is changing? First of all, obviously the bears need to bring Apple below the 221 level that I mentioned earlier. Secondly, it needs to also go below the 50 moving average at around 217. It is only when Apple goes below these two levels, then I would say bears are taking back control. Otherwise, the bulls have nothing to worry about. Finally, I know it seems unlikely to happen these 2 weeks, but I just wanted to share that watch out for this 195 to 200 area. Mark this area if you want, because this seems to me like a demand zone where buyers tend to step in. That was also the previous breakout point. So if Apple ever comes back to this area, it's worth considering picking up some shares. That being said, just some words of caution. When an area or level is a strong support, it acts like a double-edged sword. Meaning to say, buying at such level or area gives you a decent probability to ride the rebound up. But if this strong support level or area breaks, it is usually followed by a waterfall down. Therefore, to counter this, I usually will buy in tranches. Hope you have learned something here. If so, do help to give this video a like. Okay, let's now look at Tesla's chart, which looks quite straightforward to me. That was why I actually opened a new option trade. More on that later. Anyway, Tesla has 2 hurdles to clear. First of all, it is this 61.8 Fibonacci level and the short-term blue downtrend line. The second hurdle is the longer-term purple downtrend line and the 50% Fibonacci level. So last week, Tesla has cleared the first hurdle, and come this week or maybe next week, if we clear the second hurdle with a bullish cross on the MACD, I think minimally, Tesla will go up to the gap area between 234 and 245. Coincidentally, the 230s range is where the other 61.8 Fibonacci retracement level is, which means if we can clear this level and don't get rejected at the top end of the gap, which is 245, wow, I think Tesla could head towards 260s or even 270s range. On the other hand, okay, before I move on, just a quick one. If you found my weekly free content useful, do consider tapping on the free like and subscribe buttons, or comment something below for free. Or if it's within your financial means, you may also consider buying me a cup of coffee or a super thanks. Okay, back to business. In terms of the bearish thesis, watch that 219 level, because this is where the second hurdle is, the level where the purple downtrend line and the 50% Fibonacci level converge. In fact, last week after Tesla cleared the first hurdle, I posted on Moomoo that Tesla will test 219 by Friday, and it did. Right now, I do believe that Tesla will test it again this week as it attempts to cross the second hurdle. But whether it can go above it or not, I don't know, but I am swaying towards yes. That said, I could be wrong. If I am wrong and Tesla gets rejected at 219, don't panic yet. It's normal for a stock to break above resistance, which is the blue trend line, and then come back down to backtest it. I have shared this earlier and also in many of my videos. The key thing is whether it rebounds after it retests the previous resistance. If it does, that's bullish, and we could then hit above 219. On the other hand, if Tesla retraces, retests, and doesn't rebound, it means we will see Tesla going below the important 61.8 Fibonacci level again, and that's not ideal for the bulls. Thereafter, if it falls further below the blue downtrend line, then I would say Tesla has gone back into its bearish mode. When that happens, there is then a high probability that Tesla will test that consolidation area between 160s to 180s range. Okay, moving over to Google. Among all the stocks that I cover in my video, Google looks the weakest right now. As the stock attempted to rebound, it couldn't even go above the first Fibonacci resistance level at 164. Over the last 1 week, it tried to go above it on 3 trading days but failed to do so. Therefore, for this week, watch how Google continues to react to this level. If it can go above it with a few nice green candles, then it could join the other stocks in the latest rally. To highlight, this 164 level was the previous gap up level and it used to act as a decent support on a few occasions, but unfortunately, it has now turned into a strong resistance level. In technical analysis, we call this support turned resistance. Anyway, there is a positive side to this. In the event that Google can go above this level decisively, I would say there is a very high probability for Google to hit 170s range. Another positive news is that the MACD is on the verge of having a bullish cross, though it's not confirmed yet, so watch it closely too. On the other hand, if Google gets rejected at 164 again and declines further, pay very special attention to 155. I repeat, watch this level like a hawk, because if Google goes below it, that means it's creating another lower low. That's bearish in terms of price action. To add on, this is also where the 200 moving average is. The last time we tested this level was in March this year, and Google rebounded quite quickly. So if this level gets tested again and Google doesn't bounce off the moving average soon, I think we can say hello to sub 150s, which means high 140s range. Alright, let's now move over to Meta's chart. For Meta, I will have to bring out the inverse head and shoulder pattern again. In my last video, I shared that the neckline can be stretched till 530, and if Meta can go above it, it's bullish, and I would expect Meta to even go near 540 to 542. Meta kinda did that as it went as high as 539.7. At this junction, I would say Meta is at a pivotal point. Two ways to look at the chart, the bullish and the bearish thesis of course. First of all, if Meta can break above the 540 to 542 zone, then it will be entering an uncharted territory, with the bullish inverse head and shoulder playing out. And do you remember I always shared that when the stock hit all-time high, it will keep going up for a while before sellers step in, which means if we see a new all-time high this or next week, we could potentially grind towards 550s range in the near term. In the longer term, probably say by the end of the year, it could even grind up to 600. But I want to be very careful with this analysis because theoretically speaking, a breakout from the inverse head and shoulder pattern should really bring us to that level. But I just want to be a bit more conservative, so take this analysis with a pinch of salt. I mean, we are talking about the stock market. You will never know what's gonna happen in the future. So yep, keep this caveat in mind before you happily go and buy a call option. And don't forget, when you're buying an option, it has the time decay effect. Okay, on the other hand, if Meta gets rejected at the current spot, we could potentially see a bearish double top pattern. How do we look for confirmation? Well, it's a little difficult, but the first level to watch would be the 61.8 Fibonacci level at around 505. If Meta falls below that, there is then some chance for the double top pattern to play out. The chance will increase as it breaks more support levels. Okay, I know that's like stating the obvious, therefore perhaps you would want to pay special attention to 490 to 500 area. Reason being, this area has the 50 and 100 moving averages, as well as the next Fibonacci support level. If this area gets breached, I'm not scaring you, but I do think the odds of it falling below 480 is very high. So bullish inverse head and shoulder or bearish double top? We should be able to get some form of indication by the end of this week. Moving over to Microsoft. Microsoft looks decent to me as it bounced off a strong support area of 382 to 386. This is the same area where Microsoft rebounded back in April. In addition, this zone was a previous all-time high in November 2023. This means two things. First, it's a good area to pick up some shares. Not financial advice, of course. Secondly, it also means if this area breaks, Microsoft could waterfall down to low 370s or even 360s range. So it's a double-edged sword, just like what I shared earlier in the Apple segment. Anyway, below 385, in my view, the next significant support is actually at around 363. Again, like I mentioned, buy in tranches. One can consider entering a bit at 380s range and then enter again at 360s range if it falls further. But with all that said, Microsoft might not even drop back to that level again in the near future because the short-term price action looks bullish with a series of higher lows. That is the reason why I stepped in to buy a very small amount when Microsoft briefly dipped below 400. By doing so, it ensures that I have some exposure in case the stock doesn't fall into the 380s or 360s range that I mentioned. Sometimes rebounds can happen quickly and you might miss out on the upside if you wait too long. Anyway, for the upside, significant resistance levels are at around 426 and 436. Interestingly, these two levels are formed by a Fibonacci level and a moving average. If Microsoft can clear these two levels, especially 436, it is very bullish. I think that will send Microsoft back above 450's range at least. Okay, let's now check out the hottest stock in town, Nvidia. Similar to a few other stocks, Nvidia has broken above the blue downtrend line and created a series of higher lows. That's obviously bullish. And what's next? Especially when Nvidia's earnings is just around the corner. I would say pay special attention to 120 to 122 area. This is where the 50 moving average and the critical 61.8 Fibonacci level are. The longer we stay above it, the higher the probability Nvidia will grind up to around 135. If we can reclaim and close above 135, I would say it's almost certain that Nvidia will take out the recent record high of 140. On the other hand, if the 120 to 122 area doesn't hold, and given how volatile Nvidia is, I would say Nvidia could easily slide back towards the 100 to 102 area. This is the area to watch for the downside. This is where the blue trend line is, so as usual, watch for retest and rebound. Apart from the trend line, 102 is where the 23.6 Fibonacci level sits, and the level 100 by itself is a psychological support level. Therefore, by breaking below this area, I would think it's almost certain Nvidia will fall below 95 at least. In fact, if the earnings don't impress the market, a landslide could see Nvidia hitting the 80s range. Moving over to the options trading section, only one trade to update this week, which is this cash secure put on Tesla. The contract was sold on 14 August last Wednesday with a strike price of 170, expiring on 20th September. There were a few reasons for making this trade. First of all, as shared earlier in the video, we had quite a few decent economic data over the last 1 week, which includes strong retail sales, a drop in weekly jobless claims, and of course, not forgetting the two softer than expected inflation reports in PPI and CPI. All these data have given investors the confidence that the US economy is still resilient and that the recent recession fears have been overblown. On top of that, these data seem to be laying a nice red carpet for the Fed to finally lower the interest rate, which is generally good for companies. Apart from the positive catalyst in the macro environment, Tesla's chart was also showing some positivity as it has been making higher lows since the sell-off on 5th August. Specifically on 14 August, I saw that Tesla was testing the all-important 61.8 Fibonacci level for the second day in a row and was on the verge of going above it. At the same time, it was also testing the blue downtrend line, trying to get above it as well. And then we had that MACD on the brink of crossing up. As such, I took some risk by selling a put option, which is a slightly bullish move. Why I said I was taking some risk because Tesla hasn't really gotten above the 61.8 Fibonacci level and the downtrend line, and MACD also hasn't had a bullish cross yet. In short, there was no confirmation of a strong bullish reversal except for the higher lows. But fortunately, maybe I was lucky, the trade played out quite well as Tesla immediately gained more than 6% the very next day and punched through both the 61.8 Fibonacci level and the downtrend line. Then on Friday, it further printed another green candle and gained about 1% for the day. So that was two nice green candles above the resistance levels, and that's the confirmation of a short-term trend reversal. Well, risk-averse traders could always wait for such confirmation to enter the trade. But for me, at that point, I weighed the risk and thought it was worth entering. Anyway, the trade is currently sitting on a nice 55% profit. Okay, let me share some of my thoughts on the recent market movements. I am sure by now we all have noticed the significant market swings over the past 2 weeks, bouncing off the lows. To me, this indicates two things. First of all, it shows that there is still a strong demand for stocks at discounted prices. The buy the dip crowd, myself included, has been stepping in whenever stocks go on sale. Secondly, the recent trillion-dollar swings have demonstrated how market narratives, or noise if I may put it, can swing the stock market dramatically based on single data points or market chatter. And I believe we could see more volatility ahead in the next couple of months leading up to the US presidential election. Speaking of noise, remember during the recent sell-off when I mentioned in my videos that I remain generally bullish on the stock market this year and asked viewers to stay calm amid the chaos. Well, within a week or two, the market rebounded strongly. The message that I want to bring across is this shows how noise and negative media headlines can sometimes cloud our judgment and affect our emotions. That is why it's crucial to filter out the noise and focus on buying fundamentally strong companies during a sell-off, which has worked well for me so far. Anyway, the tech sector has been leading the stock market's comeback. From a technical perspective, this makes sense as tech stocks were hit hard during the recent sell-off, pushing many of them into oversold territory. Therefore, a short-term rebound was always likely. The bigger question now is whether this rebound will continue. I believe next week's earnings report from Nvidia could be crucial. In fact, it could be the deciding factor. On Nvidia, to be honest, revenue hasn't been an issue for them. The real issue or challenge now is the sky-high expectations that Wall Street has for the company. Over the past few quarters, Nvidia has posted impressive year-over-year and quarter-over-quarter gains, but this party won't last forever. Eventually, we will reach a point where it becomes very difficult to surpass the previous quarter's growth, especially after its revenue has already jumped 100 to 200% in previous quarters. And if Nvidia falls short of Wall Street's sky-high expectations, it could dampen the AI trend, potentially affecting other big tech firms like Amazon, Google, Meta, and Microsoft. Therefore, at this point, I am holding off my purchases since most of the big tech stocks have rebounded strongly and exceeded my buy points. And with Nvidia's earnings coming up in a week's time, I am adopting a wait-and-see approach, unless we see an unexpected sell-off again this week. But of course, the downside to this approach is that if Nvidia fly after its earnings, the other big tech stocks could fly along with it. When that happens, I might miss the opportunity to add more shares. But that's okay with me. The stock market is all about patience. I will sit tight with my dry cash powder and wait for the next opportunity. So what about you? What's your plan during this highly volatile period? Let me know in the comment section below. And as always, if you found value in my video, please give it a like. Thank you.